Hi, and welcome to Dot Point PS4. And this one's about the financial pressures that impact farmers, and it's including Dot Point, including the irregular nature of income, high expenditure on inputs, the dynamic nature of markets, and interest rates and risk management. First of all, this is an illustration of what we call cost price squeeze. And so this is where over the years, the costs of farming have increased. So all the inputs, the chemicals, the fertilizer, the fuel has just increased over time. But the price that farmers are getting for their products that they sell is decreasing. And so you get what's called cost price squeeze, where these two things get closer together and the margin that farmers make decreases over time, which is bad. First of all, the irregular nature of income. So this is talking about things like drought, floods, disease, pests, etc. And obviously the income changes from year to year depending on whether you have droughts or floods or disease, etc. And so, for example, a drought might reduce pasture, and hence the ability of a farmer to fatten and mature their cattle to meet market specifications, and hence it might vary their income. And so the reason it's a financial pressure, obviously if they have a varying income, they can't really know what their cash flow might be from year to year. You might have years that are good, years that are bad, and years with minimal income or negative cash flow. And so that puts a lot of pressure on farmers financially if they don't have much cash and have a lot of debt. So how can they manage this? Basically, they manage the risk by, in case of drought, you might want to store feed, such as feed for cattle, such as silage or hay bales. They can then consistently sell cattle to maintain their income instead of needing to sell during drought when the prices are probably low because there's a lot of cattle being sold. In the case of drought, farmers have a lot more control over this because they can monitor animals closely and they can ensure that they're up to date on necessary drenching and vaccinations, etc. In terms of high expenditure on inputs, obviously it's pretty straightforward. As input costs increase, such as chemical, seeds, fuel, labor, these things increase every year. However, the price that farmers receive for selling their product doesn't increase as much usually. So a good example is milk, and milk prices over the last 10 or 20 years haven't really increased at all. They've probably decreased that farmers are getting, but all the costs of producing have gone up. And so this is what we call a cost price squeeze, where the difference between the income and the costs or the inputs has gotten smaller, and it means they're making less money. So their margin is reduced over time. And it's a financial pressure because when their margin reduces, it means they're making less profit, and they basically need to accept whatever they get because they can't really determine a price much of the time. They have to accept what the market price is. And so they either need to become more efficient and get more outputs for less inputs, or they have to accept less profit. So in terms of outlining what cost price squeeze is, cost price squeeze is when costs of inputs increases at a faster rate than what income for the finished product increases at. And the difference between these two is known as the margin, and it's effectively when the farmer makes a profit. And so this means that as these two things get closer together over time, i.e. cost price squeeze, profit for the farmer decreases. So how can a farmer manage the risk of high expenditure on inputs? Becoming more efficient and producing more product with less inputs helps reduce the problem. Dynamic nature of markets. So this just means that the market price, such as the price for beef, fluctuates from week to week, month to month, and year to year. You don't really know what the market price is going to be next month or next year. You might be able to guess, and you might be right sometimes, but you can't really know for sure. And obviously it depends on supply and demand as well. And so the reason it's a financial pressure is because if you don't know what price you're going to get in 2 years, the farmer can't really plan ahead 1 or 2 years for what they're growing at the time. And unless they have a contract, they can't plan ahead and know the price for sure. So ways that they could manage the risk include planning ahead by having a contract. So we already know about sale contracts or supply contracts. And so this guarantees them a price and a known quantity that they're going to sell to someone like Woolies or Coles. And then they can kind of plan ahead and know what price they're going to get. Another thing is diversification into other crops or animals. So instead of just having beef cattle, you could have barley and wheat and that kind of thing. And even when the price of beef may drop, the price of barley might still be quite high and they can still make money in that area. So diversification is really important. In terms of interest rates are basically what you have to pay back on debt. So if you have debt, which most people do, most farms, especially family farms, have large amounts of debt, and they have to pay interest on that debt every month. And so if interest rates increase, they have to pay back more money each month. Why changing interest rates are a financial pressure. So if they suddenly have to pay back more money each month, they have to find that money from somewhere. They'll often have to take that out of production, spending less money on inputs, maybe investing less money in new technology and equipment. And so this may end up meaning they can actually produce less, and they might actually need to borrow more money because they are producing less. How can they manage it? So you can get fixed rate loans for a number of years, so they know what their repayments will be. They could also have investments off farm to produce an income, such as shares and stuff like that. They could also reduce the size of loans by paying down debt as soon as they can, and that helps reduce the amount of interest rates or interest that they have to pay back on their loans. In terms of risk management, there's a number of things they can do here. Basically, diversification involves having more than one enterprise on a farm, which we've already talked about, so that drought, disease, low market price, the chances are that the other enterprise might not be affected by that thing. So if you had sheep and wheat and you had some kind of sheep disease, then the wheat wouldn't be affected by that, and you'd still get a good price for that. Investing capital in off-farm activities such as shares on the share market, buying property, owning a retail business, etc., and you'll get money from that instead. Buying insurance for various things, but that's very expensive, so it's probably not done very often. Keeping reserves of feed for animals and also reserves of cash in the bank for when you need it, particularly for family-related expenses. And lastly, not over-investing in capital equipment such as machinery that you do not use much. It's better to contract people to do this work rather than owning the machinery much of the time. This first past HC question from 2011, explain how interest rate trends over time affect decision making for a farm. So I've said interest rates change over time. Interest is paid on debt and is the cost of borrowing money. If interest rates go up, farmers must repay more each month. This money must be taken from somewhere. Example, farmers may choose to decrease expenditure on inputs, reducing production. They may also spend less on new machinery, also leading to possible decrease in production. So I've shown clearly there how fluctuations in interest rates affect decision making. This 2012 question, this is showing normal seasonal fluctuation. This is a one-off, really large increase in price, and basically the reason for that is because there's unseasonal weather, unusual weather. It's basically saying, and that if you have less of something because of bad weather conditions, that means that the price is going to go up because the supply has dropped, and so the price will go up. Importing more will drop the price. Normal seasonal variation is already shown in here where it goes up and down, and a significant reduction in demand is not what this shows. So how do rising input costs affect decision making? I've given you an answer here, which you can have a read of by pausing. A farmer has borrowed money to establish an enterprise for export market. What is the most likely effect of an increase in Australian interest rates? Basically, if interest rates went up, you'd have less profit because you'd have to spend more money on paying back the interest on the loan. And so total farm costs would increase. A is the answer. Profit would increase because costs of production would decrease. No, they wouldn't. There would be no effect on profit. That's not true. Because the product's being exported, you still have to pay interest no matter where it's sent. And then profit would increase because product would become more competitive, and that is not related to interest rates. So A is the answer. And lastly, this is an answer I've written for question 2014, question 27A. You can pause it here to have a look if you want.